Welcome everyone to our Crypto Tax Audit AMA on how to prepare your taxes for your cryptocurrency reporting this year. My name is Clinton Donnelly. I'm the CEO of Crypto Tax Audit. With us also is Ben Weber, who is our Director of Crypto Analytics. He handles the entire analytic team. That's the team that does the calculation of gains of your crypto transactions. In this webinar, we're going to have some initial comments about some things that have significantly changed in how you report your taxes this year. We're going to talk, Ben and I are going to talk about those real quickly. Then maybe about 15 minutes. And then we have a number of questions. Many of you sent in questions ahead of time, and we're going to go through the most important ones of those first. And then if you provide a question in the chat, we'll pick that up and we'll handle some of the most important ones there at the last part of the show. And if we don't get to your question, please be watching our shorts, our YouTube channel, and our X channel. We'll be getting to all the questions that were unanswered during the time afterwards. So I hope that every question will get answered, whether live or later on. Thank you very much for attending our show. We have a tremendous attendance, and let's get right on to it. The government passed changes to the tax law to increase the amount of reporting that was necessary for cryptocurrency taxes. The IRS put forward regulations, and they went into effect actually at the beginning of 2025. But most of you are not going to realize it till you start to do your taxes now for the prior year. So one of the most important changes is that now crypto exchanges that operate in the US, these decentralized exchanges, Coinbase, Robinhood, Uphold, Kraken, are now going to be issuing a new type of 1099 form. It's called a 1099-DA. This is a form that goes to you, but also a copy of it goes to the IRS. And it's going to have a whole lot more information than you've ever seen before. Many of you have seen 1099s, say from Coinbase, that are like a 1099K or 1099 miscellaneous. And it was typically just one big number reported to the IRS. But the 1099-DA is going to be more like a 1099-B for you who deal with stocks. It's going to list every single sale or exchange that you had during the year. And it's going to list the total value of what was sold. So it's going to be a lot more detail given to the IRS. It's going to be every single transaction. What is not going to be reported is going to be purchases. And it's not going to be reported is transfers in and out of your wallet, not for this year. So this is a big change to 1099-DA. You need to account for the 1099-DA on your tax return. So make sure you give it to whoever's preparing your taxes. If you're doing it yourself, you have to account for this. If you don't report this or enter it into your tax return when it's being prepared, you just bank on getting audited. It'd probably be a computer-generated audit. The IRS is going to think you didn't report everything, and you're going to get a letter, and they're going to demand money. So pay attention to this. The 1099-DA, there's a form that they show on the web. You may have seen it, but it'll probably come to you more in a spreadsheet fashion, listing every single transaction in columnar format, the date and time stamp. It'll also have your name and a social security number on it. So this is a big change in terms of how we do our taxes. The second big change is how you report your your actual trades on your tax return. We typically enter this into Schedule D, which is where capital gains is reported. Any type of capital gains you have is entered on Schedule D, whether it's real estate or stocks or other sort of transactions. It would happen on Schedule D. But the totals there are brought in from a form 8949. And the 8949 is kind of a spreadsheet looking form. We list every single trade. Now, what's different is that they have added new boxes that when you submit the form, you write your crypto trades on a special 8949. This is what's interesting. We'll show you this. We're going to have my staff is going to bring up an image of the 8949 form. And in the past, there's been 3 boxes for short-term and 3 boxes for long-term gains. The short-term gains for ABC boxes, you can see it there just above the highlighted green area. That's what the old form used to look like. Any sort of capital gain you had, whatever it was, you marked whether it was A, B, or C, which indicated whether the IRS knew about the cost basis. There's also a D, E, and F, which is for long-term capital gains. Now you can see here they've added new columns. Here we have highlighted G, H, and I. This is for breaking out just the crypto trades. And then there's another form for just for the long term, but we don't have to show it now. To be some additional boxes, JKNL. Now, what's really unique about this is that when you prepare a tax return, you don't distinguish to the IRS what type of capital gain it is. This could be a stock, this could be the sale of some other property. But now, for the first time, the only type of property that is separated out is cryptocurrencies. They will be separated out. Now, here's how the IRS is going to use this. By breaking it out this way, they're going to total the proceeds that you report on these in these highlighted boxes, and they're going to match it against your 1099s. And this is going to give them a laser focus insight in terms of, have you reported all the proceeds that were reported to the IRS on the 1099? Here's the secret to avoid getting audited. The amount of total proceeds that you report on these new boxes needs to equal or exceed what is reported to the IRS on the 1099 forms. Otherwise, you're going to get the audit. So this is so in contrast to prior years, now reporting your 2025 taxes here in 2026, you're going to have IRS going to have a lot more detail. This is going to be the foundation from which how they examine people's tax returns. So this is very unique. If you haven't received the 1099 DA, start looking in your mailbox. I think Coinbase has just started reporting them. Kraken, some of the other exchanges, they'll be giving them to you or telling you to pull them off the website. So make sure you account for all those, lest you have an inaccurate tax return. The next big change that happened with the tax regulations is called a requirement to do your capital gains using the FIFO by account method. FIFO means first in, first out. And I'm going to ask Ben to explain how this differs from what we did in the past.
Yeah, so this is a change that you should be aware of when you're tracking cost basis. There's really two types of methods out there. Two ways to track cost basis. You have the universal method and this by account, or you may have heard by wallet. And then you also have these methods of how cost basis is ordered. You have, in the past, you probably used FIFO, HIFO, or LIFO. So I'll just start off with what the difference is between the by account or by wallet method and this universal method. In the past, a lot of crypto tax softwares, the default was this universal method of tracking cost basis. And this is really, when you think about it, you're tracking cost basis across by your entire portfolio, as if your entire portfolio was a single account. So you're not worried about, when you're calculating capital gains, where the cost basis is coming from. If you sell a Bitcoin on Coinbase, that cost basis could come from Bitcoin anywhere within your portfolio, and any of your wallets, any of your exchanges. This was, an easy way to track cost basis, but the IRS is now requiring, starting January 1st, 2025, that taxpayers track their cost basis by account, or you may have heard by wallet or wallet-based, tracking. And this is different. So each wallet or account will be tracking the cost basis in those assets separately. So in the previous example of, selling Bitcoin on Coinbase, if I also have Bitcoin in my ledger, I have, at the time of the sale, I'm tracking, all my Bitcoin in Coinbase and what the cost basis is for those tokens. And then I'm tracking all the Bitcoin in my ledger and the cost basis for those in the ledger. So if I sell Bitcoin on Coinbase, the cost basis can only come from Bitcoin sitting on Coinbase. It can't come from anywhere else in your portfolio or in any of your wallets. It has to be from Coinbase. So this makes the tracking of cost basis more specific, more detailed. You really have to know, when you buy a Bitcoin or any token on Coinbase and you transfer it to a wallet, you're saying, okay, this Bitcoin I purchased on Coinbase, and I'm transferring to my ledger, it has a cost basis of $10, and now it's sitting in my ledger. So you're tracking for that separately. So every time you make transfers, you're tracking that cost basis as it transfers with the asset. If you have a lot of transfers going in and out of wallets, if you have a lot of exchanges or a lot of wallet addresses where you're transferring assets, this is going to make reconciling the crypto transaction a little more tricky. This is, you have to be detailed. You have to line up and match the transfers, the withdrawals from your exchange and the deposit to your wallets. So it makes it, you have to be more diligent in how you do the calculations. And there's tools out there that help you do that. Each tool has its pros and cons. So you just have to be aware of that when you're accounting for these in these crypto tax softwares. The second change I mentioned just earlier was that using FIFO versus HIFO or LIFO. So Clinton just said earlier that FIFO is required. Now that is the default method that you use. Now you are allowed to use specific identification. However, you cannot apply it retroactively after the transaction has occurred. You have to use specific identification before the transaction. That's by transaction, I mean trade or transfer or other type of transaction. You have to identify the unit of cost basis that you choose to trade or transfer before the transaction occurs. You have to record that in your books and records. And that is just a very hard thing for a lot of people to do before you make a transaction. Most people don't have an up-to-date list of their cost basis, and that's what would be required to use specific identification. So FIFO is most likely going to be the default for a lot of people. It will be hard to apply specific identification because of these requirements. There's other ways you can think about how to structure your wallet to get more beneficial outcomes. I'll just give a short example of that. If you're buying into a token, let's just use Bitcoin as an example. You could have all of your old Bitcoin that you purchased a long time ago in wallet A, and now you start buying Bitcoin again. It's 2026. As you buy that, you want to transfer it to a wallet. I would recommend transferring it to a new wallet. We can call that wallet B. Now all of your new Bitcoin tax lots that were acquired in 2026 that have a high cost basis are sitting in wallet B. So when you go to sell Bitcoin in the future, let's say it's the end of 2026, you have two options. You can say, hey, I have a wallet A with all of my old tax lots. Those are going to be long-term capital gains, but probably a higher gain because they have lower cost basis. Or you have wallet B with all of your recently acquired Bitcoin, which has a higher cost basis, but if you sell it, it's short-term gains. So there's ways to think about it by using utilizing the by wallet tracking to strategize for your taxes and decide which tax lots you're going to sell without even applying the specific ID method. You would just be using FIFO and choosing the wallets that you want to sell from.
Thank you, Ben. Let me just touch on a couple quick points here before I go into, I'll talk a little bit about our company, then we'll start addressing the questions. The 1099s are only going to report for this year, only report your sales and exchanges. By that, I mean, anytime you do a crypto to crypto trade or you do a crypto to cash trade, these are the only transactions that'll be reported. Earlier versions of the 1099 suggested that transfers would be reported. They will not be reported. There may be a reporting of transfer quantities of coins, but it will not be reporting the wallet addresses that were involved. So that was a bit of a change. Secondly, exchanges that are not US based centralized exchanges will not be issuing 1099s. In other words, if you're trading on Uniswap or any sort of decentralized exchange, or if you're trading on a non-US based exchange. Now, some foreign exchanges actually have US offices, so they might be issuing a 1099, but not all of your platforms may be issuing that. And just in case nobody picked up on that, FIFO means first in, first out. It's etc. So let me tell you briefly about our company. This is the ad portion of it. Our company, we've been around doing crypto tax returns since 2018. All we do is crypto tax returns. We calculate the gains, which is very complicated. We do the tax return, and we do also audits. Now, when we do gain calculation, what's unique about us over, say, using a coin tracker, coin tracking, coin ledger service is that we are full service. We do the entire calculation for you. When you contact us, we'll give you a fixed price quote for that. We're so confident of our ability to do the work. Now, you might say, wow, it's a whole lot more than paying just a couple $100 to have coin tracker do it. And yes, it is. But I'll tell you that if we almost always, like Ben said, 99% of the time, we're going to come up with a total gain, taxable gain of a far less number than if you do it yourself. And that results in a tax savings, which more than covers the cost of our gain calculation services. You can also use, some people just have us do the gain calculation for them. Other people also have us prepare the tax return. And the tax return, our methodology of preparing it is what we call a bulletproof crypto tax return. We include additional forms you wish were there. If you knew in advance, you're going to be audited. I should mention on terms of gain calculation, if you are a frequent trader, I would suggest, when you look at your gain calculation, if you use one of the online services and you say to yourself, wow, I didn't make that much profit. If your gut is telling you that, you should go with your gut. And if it's a significant number, I'd say if you're coming up with a number that's in your gut that's $10,000 or less or more than what these online services are doing, then it will pay for you to have a full service calculation by us. Give us a call, have a consultation. You can go to our website, CryptoTaxAudit.com, go to the contact page, and you can schedule a consultation with Ben, Sarah DePino, our director of tax, or Kent, who is our director of tax resolution. If you're I guess the key thing here for anybody who is listening is that the IRS is really focused on getting everybody to report their crypto income. They still feel that about 75% of crypto traders are not reporting their income. It's getting harder to hide. If you'd like a strategy for getting into compliance to keep yourself out of hot water with the IRS, give us a call. It's private and you'll benefit from it. We also have what's called a TaxShield service, which is a service where we proactively monitor your IRS accounts. We can see in advance if you've underreported your income from what the IRS knows about, or if the IRS has flagged one of your accounts in advance for audit. We can see this flag about 6 months before an audit actually starts, which gives us enough time to work with you to fix the return and prevent the audit from happening. So if that's something of interest, go to our website and learn more about that. So let's handle our first question that's come up. And my staff is going to put it on the bottom of the screen for me. Ben, you want to handle these?
Yeah, absolutely. So, does the Safe Harbor Global Allocation Plan completely eliminate the risk of future audits on crypto gain reporting for years prior to 2025? So, this did not eliminate the risk of being audited because there's no official form submitted to the IRS to show that you've done the Safe Harbor. The Safe Harbor is a series of steps that you take. One is to adopt a global allocation plan before the end of 2024. This should have been done over a year ago. The second step was to take inventory of your assets by each wallet or account on December 31st, 2024. So you know what your ending inventory balances are, what each wallet and account holds. Then the final step is to perform and execute the global allocation. And this is taking all of your cost basis for all the assets you held at the end of 2024 and allocating them to what your wallets actually held on December 31st, 2024. So the cost basis is being carried over into 2025. It's just being ordered into your wallets and accounts so that you are transitioned to the new IRS regulations, which is the by account or by wallet cost basis tracking. Because most people use the universal method in the past, the IRS realized that some sort of accounting procedure or allocation needed to be done, and that's why they came up with the safe harbor allocation, because they realized there's going to be a huge disconnect from what people were doing in the past to what the new regulations require, and that's what the safe harbor is. The safe harbor also preserves your prior year cost basis tracking. So there's no anomalies between, any errors between converting from the old method to the new method. You're now transitioned. Everything is like in harmony, so to speak.
Next.
If I've only bought crypto, never sold or swapped anything, do I still need to file any tax forms? Good question. So if you've never sold crypto or traded crypto to crypto, there are no trades that you need to report, nothing to file to report. That being said, I still highly recommend to track your cost basis on the purchases and assets that you hold. The longer you go without tracking your cost basis and reconciling your transactions from year to year, the harder it will be to go back and do that accurately. You'll thank yourself later if you do this now. When you go to report in future years, or if you get an audit in future years, you'll be happy that you already have everything squared away and reconciled. And just another comment there, even though you've never sold or swapped, if you're earning staking rewards, you have to report those. Those are reportable as income. What should we do if a reporting broker doesn't have cost basis for a crypto asset that was sold? This is a very good question, and I think this is going to be, a lot of people are going to see this. I think if you don't see this, you're in a small minority. I think most people are going to see that the exchanges or brokers are not tracking cost basis appropriately, and here's why. If you buy an asset on Coinbase and then transfer it out and then transfer it in, the moment that asset goes out of Coinbase, they stop tracking the cost basis on it. And when you transfer it back into Coinbase, they don't know what you've done, where that token has come from. And so they now don't have a cost basis for that asset. Now, what you might see is in these brokers, they might ask you for the cost basis. If you have the cost basis for that asset readily available and that is accurate, you can provide it. If you don't know what the cost basis is for the asset, I would recommend leaving it at zero. And I'll explain why in a moment. And just have the broker report at zero. If you go to start putting in cost basis and that's incorrect, that might cause problems for you later down the road when you go to file your tax return. So if you don't know the correct cost basis, leave it at zero. At the end of the year, the broker will still have a zero cost basis. And let's say you'll have to reconcile all your transactions to calculate that cost basis. The broker still reports zero cost basis. Well, now you have an opportunity when you file your tax return on Form 8949 to report the cost basis on those assets that show zero. The IRS will be aware that there's going to be instances where the broker does not know the cost basis and that you are supposed to provide it. So that will not be unusual, or it will be completely normal to report the cost basis at the end of the year correctly on 8949, even if the broker reports zero.
Can I add a comment to that, please, Ben? Because of the difficulty that the exchanges had trying to comply with the 1099 DA, Here in this first year, all that is going to be on the 1099 is the proceeds of sales and exchanges, not the cost basis. In next year, in 2027, for the tax year 2026, the brokers will report the cost basis if they know it. And this is what Ben was talking about. If they know it, they'll report it. Now, let's talk about how that looks. If you are someone who is accustomed to trading stocks and you buy on a stock exchange, say you buy your stocks at Schwab, you buy it, you hold it at Schwab, later you sell it at Schwab. Schwab knows what the cost basis was. And in the stock world, people buy on the exchange and they sell on the exchange. They never move their stocks off the exchange. So the 1099B, which is what's reported for stock exchanges, is a very good form. It reports the what you bought it for, what you sold it for, the dates, and it makes taxes very easy. However, we all know that not your keys, not your crypto, and nobody really wants to leave your cryptos on any exchange. You want to bring it to a private wallet. Well, now when you bring it to the private wallet, and then you later bring it back to the exchange, as Ben has discussed, the exchange has no idea what the cost basis was. So the 1099 at that in 2027 will be blank for the cost basis, and it'd be very rare you actually would be able to know what the cost basis is. So it simply is going to make the tax return uglier than if you lived and breathed on just one exchange and kept all your assets on one exchange. If you bought everything on Coinbase, you left it on Coinbase, maybe in their vault, and you only sold it on Coinbase, you did everything on Coinbase, you would get a very attractive 1099 DA, and your taxes would be very easy. But I think most of us realize that's a foolish approach. So that's just to summarize that. All right, thanks. Next question.
What practical steps can someone take to reduce their chances of a crypto-related audit? The first step is report your crypto income and capital gains. Try to do it as accurately as possible, or use somebody who knows what they're doing, like us. We specialize in this crypto reporting. The second thing I would say is, Quentin mentioned this earlier in the call about the 1099 DA. When you're reporting your proceeds on the 8949 on your tax return, those proceeds should match what are shown on the 1099 DA. And if they don't match, they should show a higher number because maybe you're trading elsewhere as well. And the IRS typically, their computer systems, they track inconsistencies through matching. And so they want to match up all the income that was reported to them, and all that income should be reflected on the tax return. And when the numbers don't add up, that's when letters go out.
Another way what Ben said is exactly true. Another thing you can do to reduce your chances of an audit is to become, and despite who's preparing your tax return and how you calculate your gain, you should become a member of our TaxShield subscription service, where we actually will monitor your IRS records. We can detect from the IRS transcripts if the income you reported on your 8949s is not as much as was told to the IRS through the 1099 DAs. We can detect that. It's a red flag. We can let you know. It gives us a chance to correct the return if your tax preparer did it incorrectly. And also other types of audits that might occur, we see those flags. So that's kind of like the foolproof way. And as a part of that, we also offer a service, it's an additional fee, where we can do a review of your tax return. If you're having someone else prepare your tax return and you'd like to get a second opinion after they've prepared it, you can schedule a call, have a consultation with our Director of Customer Services, Kent Bowen, and he can review that with you. Just make sure some of those things tie out and reduce your chances. Great question.
Who at your company specializes in tracking crypto transactions for tax purposes? Well, you're talking to them right now.
That is what our company does.
This is I have a team of about, I believe, 9 to 10 analysts who are all great, who've been with our company for several years, working specializing in tracking cost basis, doing these crypto reconciliations. I can't speak more highly of my team and the professionalism and skill that they have in getting the job done. They really know what they're doing. They've seen, a lot of them have 4 or 5 years experience doing this. They've seen all sorts of blockchains, types of transactions, DeFi, NFTs. They can, pull, data from the blockchain, rework it. They really work magic. And I can't be more thankful to have them. And, that's really, this is what we do every day. So, if you have a question, get in touch with us, get in touch with me and my team, and we can help you with your crypto transactions.
One of the things, Ben's team is the best in the industry. We are known by name over at the IRS, at the appeals office, and even some of the audit group. Oh, your CryptoTaxAudit. They respect our calculations and our professionalism and expertise. We have destroyed the IRS in audits and in appeals, and even though in tax court cases, we have defeated them numerous times because of the quality of Ben's team, and so I highly recommend it. That's what our company does. Next question.
I don't have a large amount of crypto. Some services feel out of reach. Are there budget-friendly ways to still get this right? Yes, there are. There's several tools out there, crypto tax tools that you can Google that are good. Find the one that works for you, that you understand, and that supports the activity that you're doing. So it supports your blockchain, supports the exchanges that you use. So those are 2 key points there. One, just to summarize, that supports all your activity and that you feel comfortable using. I would recommend, don't do this all at once. If you're going to start tracking, reconciliate your transactions, start, now when you've just started in crypto. And when you make a transaction, go on to the software and make sure that the classification is correct, and do that proactively and consistently throughout the year, so that at the end of the year, you're not stuck with thousands of transactions to reconcile all at once. I mean, I don't even remember what I did 2 days ago. I'm not sure how I'm going to remember what I did, a year ago. So that's my my advice.
I would just add to that. Go ahead and use, if you use it before, use one of the online services. There's about 6 of them left that do that. And then when you've done the best with them, ask yourself in your gut check, how much gain do I think I made last year? These services will come up with numbers almost always higher than what your gut check is. If it comes in within the range that your gut has, then great, use that number to do your taxes. But if the number doesn't fit your gut check, almost always the number's too high. Let me tell you a story. One of our clients who's works Digital Chamber of Commerce, and we were talking, he said, Clinton, I used the service and it said I owed $140,000. Yeah, I said, there's no way I made $140,000 in profit. And I said, well, how much do you think you made? He said, I think I made about $90,000. All right, so that's like $50,000 difference. I said, if you pay for our services, and I think the price for him was roughly around $3,000 to do the gain calculation. I said, we're going to save you enough money. It's going to pay for the entire gain service, right? Don't step over $1 to pick up a quarter. So he actually hired us and did the calculation. Actually, the total gain he came up with was actually $87,000. So we reduced his gain by $53,000. The tax savings on that is going to be in the neighborhood of $20,000, more than paid for the full service. Trust me, he's a believer and uses us every year going forward. So always believe what your gut is. Don't pay more taxes than you have to. You do not get brownie points from the IRS for paying too much taxes. Next question.
You mentioned that FIFO will apply under the new rules. Does this affect the tax return we file for 2025 and 2026? Yes. The FIFO, if you haven't used specific identification, which you can't use retroactively, FIFO is the default. Can I still report capital gains or losses using specific identification if I track everything myself? Yes, you can, but you have to identify the units of cost basis before the transaction occurs and record that in your books and records. The biggest challenge there is a lot of these softwares. I haven't seen the functionality to choose tax lots yet, so it's going to be a challenge to do.
This is a really big thing. In the past, in a sense, everybody did specific identification in different types of ways, whether it was a FIFO, LIFO, but there's all specific identification. But now, since you have to tell the exchange which specific lot you're trading, what date you bought it, and the price before the trade happens, we feel that the entire specific identification method is virtually unworkable except for the smallest of traders. It's virtually unworkable, and you cannot do a blend of these things. And we just don't see how anyone can keep track of this unless you just do very few trades. Next.
Can I assign cost basis lots however I want, or do I have to choose a method like FIFO or LIFO? Again, FIFO, retroactively, FIFO will be the default. Specific identification is going to be very complicated, if not impossible.
To be very clear, you cannot use LIFO anymore. Although you can make specifications by exchange, you can tell the exchange to always use a LIFO method or an ultimate method. But if you tell exchanges to use one method, but then when you look at all the other exchanges and the movements between private wallets, it's going to be virtually unworkable. So I highly encourage you to do not tell the exchanges to use any method other than FIFO. It's just going to create real nasty situation for you in terms of if you get audited.
It's going to become complicated to, at the end of the year, if you're using multiple exchanges or wallets to reconcile everything. And that this kind of comes into the next question as well. When I logged into Coinbase, I saw a notice saying my account is set to FIFO. So yes, I would recommend leaving it there. The only instance, I would say do what you want is if you're only using one broker, you're not transferring any assets out of that broker or assets into that broker. In that case, I would say go ahead and use HIFO because it's one singular exchange. You're not going to introduce a lot of problems on the accounting end because you only have one exchange. To the second part of this question, if we receive Ben's allocation report, are we covered? So the allocation report, that is for safe harbor. We've been doing the safe harbor allocation for our clients this year, and that covers you and transitions you to the new IRS by account methods. So you are covered, you're ready to go for January 1st, 2025 and to report your 2025 taxes. If I transfer from an exchange to a hard or cold wallet, is that considered a sale that needs to be reported on Form 8949? That is not a sale. However, when you're doing the reconciliation, you're going to be tracking the transfer along with the cost basis associated with that transfer to the new wallet. If I move crypto from a brokerage account like Robinhood to a cold wallet, would that be mistakenly treated as a redemption and included as proceeds on Form 1099-DA? They will not be reporting transfers, and they should not be reporting them as sales. If my crypto tax software can't accurately reflect my holdings because of missing or incorrect data from exchanges or wallets, what should be done in this situation? I've seen this all too often, especially going back many years. Exchanges have either bad data or you get kicked off an exchange, you can't get that data. There's always, something can always go wrong. Try your best to, the first thing you should do is go through and see where the error is occurring. And if it's a result of missing or incorrect data, correct the data or make the correct transaction in the software so that the ending balances are corrected. There should be some sort of adjustment that needs to be made, or might need to be made if the balances are off. If the balances are off by immaterial amounts, I wouldn't sweat it. But if the amounts are material in nature, and that is just all based on the size of your portfolio value and the value of the transaction or the amount off. So you may need to go back and reconstruct data or make an adjustment to fix the ending balances. How do I document cost basis differences across multiple 1099 DAs? And can I confirm that Coinly is calculating cost basis correctly under the safe harbor rules? So across multiple 1099 DAs, this won't be an issue for 2025 as exchanges and brokers are not reporting cost basis. But for 2026, this is going to be an interesting issue for a lot of people. There'll have to be a way to reconcile once you reconciled all your transactions and calculated your gains, reconcile the cost basis that's reported on the 1099 DAs. That's an issue, for next year. We're still kind of observing this issue and seeing how it's going to play out with what the exchanges are going to report. But you're either going to have to make some type of manual adjustment to make this to fix the differences.
Let me interrupt here as we're going to switch to doing some of these questions have all come from in advance of the webinar, and now some people have been giving us great questions, and we're going to be switching to those next. But while we get ready for that, I just want to say, as you can sense, it's getting much more ugly to prepare the reporting of your crypto tax returns, and we haven't seen how each of the exchanges is doing it, and each one there may be some variations on how they do it. So we're going to be actively monitoring it. We'll let you know through our X channel or YouTube those sorts of anomalies. But what can you do to feel safe that your tax return that you've been done right if you're not using us? Well, first of all, we believe that most tax preparers are going to be absolutely clueless and terrified of these new 1099 DAs. They're going to put the entire burden back onto you to tell them what to report. And so here's the key. They need to report to 1099 and on the form 8949. And then what we would recommend, actually, if you could put Liam, if you could put the 8949 back up on the screen, I'd like to show somebody. Can you scroll it up a couple lines, just a little bit? Okay, now, if you look at this screen, you'll see in the spreadsheet part at the bottom, it says description of property, and you see the A above it. This is column A. This is what you're going to enter here. You can say Coinbase 1099, and you're going to take, it's going to be date acquired. You're going to say various, date expended, various, proceeds, and here you're going to enter the total amount of proceeds that's on the 1099 from Coinbase. And then what you're going to happen is over here in column G, you're going to see adjustment. And here's adjustment, you're going to subtract the total amount of proceeds off, okay? So that in column H, where it says gain or loss, it's going to end up with a 0, all righty? This is how you account for the 1099. Now, the rest of the form, you're going to enter the results that you got from using your crypto gain tool like Coinly, whatever. You're going to put those in here. If you do it this way, here's a subtle benefit that you're going to happen. Is that the total proceeds that's appearing on the 8949 will significantly exceed what the IRS is expecting. And that'll put you into a safe category, not someone whom they're going to go after, all right? But you have to account for every 1099 DA. Your tax preparer needs to account for it. It needs to be on there. The second thing you can do, because this is a very crazy year and people are going to adjust it to this change, is you can schedule a consultation on our website with Kent Bowen, and he can do it's like a 15, 20-minute review call. We review your tax return just to check off, make sure things are correct. That might be a great way to help you sleep better, get a second opinion. All right, our first question from the chat group is,
are wallet addresses reported every year on tax returns, or are they only used for calculations, tracking, and record keeping? Great question. They are not, the wallet addresses are not reported on your tax returns. They are used in the calculations, tracking, and record keeping. If you get audited, the IRS is going to ask you for all of your wallet addresses, and I recommend providing all of them. And even if you're doing, you have an accountant, I recommend providing all of them. That will help ease your life and ease the life of your accountant when they're doing these calculations. Now, I think, Coinbase, Kraken, these brokers are going to have access to, your wallet addresses just through transfer in records. So it wouldn't be unthinkable that the IRS might be able to get their hands on these wallet addresses if they wanted to. I don't know what your thoughts on that are, Clinton.
oh yeah, I mean it's a simple matter of a subpoena to Coinbase to turn over the wallet addresses associated with each individual transaction. So even though initially they had put it into the 1099, you had to report the wallet address, but I think they realized that they didn't have to be that aggressive. If they really want to come after you, they can start pulling that data from all your 1099s that you got. They'll get the wallet addresses. From there, there's a methodology where they can walk the blockchain and reconstruct any other addresses. And they have a way, the scientific way of determining which are your hidden wallets. And they can reconstruct your entire portfolio. This is what they did for Roger Ver, Bitcoin Jesus, to determine how many Bitcoin he had 10 years ago when they sued him for $50 million.
Yeah, it really isn't rocket science when it comes to trying to figure out what these wallets are. I had a person several years ago who didn't want to give up their wallet addresses and wouldn't give them to us for the calculation. And so my team, they just went through and we were like, oh, are these your wallet addresses? Because it looked like they were. And then he disappeared. So I don't know what happened after that.
You can't. It's getting tougher and tougher to hide. And if you've been someone who's not been reporting all your crypto reports or even any of it, I would highly suggest you schedule a call with my staff on the contact page and let us work with you to put a plan to transition into compliance in such a way that you can avoid having an audit. The last thing you want is an audit. We had an audit that started in the year 2020. The IRS came up with wild numbers. We argued against it. It's now up in tax court. It's now the year 2026. His audit is in tax court, and there's still no resolution in sight. We're certain he's going to win, but it's just a drawn-out process. You will lose hair, possibly your marriage, and you'll lose a lot of money if you don't take it serious. You really, really, really want to avoid an audit. So pay attention here. Next.
What if an exchange does not report cost basis because the asset was purchased elsewhere? Can I provide the cost basis on Form 8949 to accurately correct proceeds without triggering an IRS issue? So to answer the first question, yeah, that's exactly what this conversation is about. Is there's going to be cost proceeds reported on the 1099 DA, and not for this year. Everything will be, the cost basis will be zero. But for next year, there's going to be zero cost basis on assets that you transfer into Coinbase or any other broker, and that's going to be pushed back on you to fix and provide the correct cost basis when it comes to reporting on Form 8949 or your accountants. And then when you're, as Clinton said earlier, to answer part of the second question. You want to make sure that your proceeds on the 8949 match the 1099 DA. If not, they should be more.
Let me give you 3 strategies. You're gonna have to live. Each person here on this call is going to have to follow one of these 3 strategies. The first strategy is I buy everything on one exchange, I leave it on the exchange, and then I sell it on the exchange. In that case, the exchange will be able to report the cost basis accurately. and doing your taxes will be very simple. The second strategy is to move some of your coins off. Now, when that happens, when you bring them back on to sell them, the exchange will not know and cannot report the cost basis. However, if you do a mixture of those two methods, then some exchanges, some transactions will be, their cost basis will be reported. And when it is reported, then when you're doing your calculation using a service like Coinly, you're going to have to work around these kind of locked-in cost bases, which could be extremely complicated. We haven't seen exactly how it's going to work out with the various tools there. So I would suggest for most people, if you're not going to leave everything on the exchange, then move everything off, even if it's just for a day before you move it back on to sell it. This way, the exchange cannot be in a position to ever know what the cost basis is. In that case, your 1099 will look like the ones you're getting this year, where there is no cost basis. I ultimately think that's going to be the easier approach. And, not your keys, not your coins. Protect yourself. Next.
Are staking rewards taxed when they are received or when they are sold? This is the IRS came out with a revenue ruling a couple years ago that stated that crypto staking rewards are taxed as income when they are received, and the value that you report will be the fair market value at the time when you receive them, and it will be considered ordinary income.
It is not covered by the Clarity Bill. There is a bill in Congress called the Digital Asset Taxation Act that Senator Cynthia Lummis put forward, which does propose switching it to being taxed only when sold. This is not currently being deliberated. It'll probably be discussed next year. We'll have to wait for the Clarity Bill to pass. I don't know if it'll happen or not. There are some people who would rather take the position that it's not taxed when received, and we've done this for some people where we don't report any income upon receipt. We disclose it in the tax return, which is the safest thing to do. And generally the people have a good reason for that. So if you think that's you, why don't you give us a call, we can talk about the situation.
How do you report lost or stolen cryptocurrencies? So this is a great question. First, if in a lot of cases, when you just lose cryptocurrencies, you send it, let's say, to the wrong address, or you lost your keys to a wallet. These are going to be capital losses. So the loss will be equal to your cost basis in these assets. Now, there are a number of the IRS came out and stated there's a number of cryptocurrency scams that you would be eligible to report these losses as ordinary losses, because capital losses are limited to $3,000 against ordinary income. These so certain scams like pig butchering fall into this category, and you are allowed. It's going to be considered a business loss, and it'll be reported on your tax return, and you can take that loss against your ordinary income. Now, the amount of the loss, the value will be equal to your cost basis in those assets. I don't know if you want to say something else about this, Clinton.
Yeah. First of all, if you lost assets or got scammed out of it, it's very sad. It's very grievous. But the silver lining is you can claim some benefit on your tax return and lower your taxes to the amount that you invested and lost. It is involves a special form 4684 to report a business loss, because this is basically your investment business. It can be complicated, but we have successfully done it for countless customers, and it can be a big savings. What happens when you do it this way is you get to deduct it on your itemized deductions in Schedule A, so it's actually going to be a big impact. I have a question here that I think is also a great question. I'm seeing here. It's not written up there. It says, what is the best way to take a loss for a worthless crypto that doesn't trade anymore? A lot of people had significant losses on cryptocurrencies last year. If you traded in certain altcoins, a lot of altcoins, if they've become worthless, the IRS requires you to actually dispose of them. Now, how do you do that? There are burn addresses, like Ethereum burn addresses, where you just send it that address and it's gone. And that is, in effect, a disposal, and you're trading it for basically $0. And so you're recognizing the maximum loss that you can from what you bought it for. So a little thing there. Just a couple questions, one more.
Will exchanges change their calculated cost basis if you contact them? If they've calculated the cost basis, I don't believe you're going to be able to influence what they're going to report. That doesn't sound very likely.
They have rules that they have to follow.
Yeah. Exactly. Next question. How should non-KYC Bitcoin held only in a cold wallet be reported if it was acquired before 2017 and never sold? Assets that aren't sold are not reported. There's really no difference, if the Bitcoin was acquired through a non-KYC method. The IRS isn't, worried about, how you acquired these. They're worried about reporting income when you sell or when you earn it. So, if you bought Bitcoin a long time ago or got it somehow, it doesn't really matter as long as you track the cost basis. And when you sell it, report the gain. That is what the IRS wants. Do you need to log into foreign exchanges yourself to gather information, or is that research handled another way? Yes, you would need to, if you traded on a foreign exchange, you're going to have to download all that transaction data to reconcile at the end of the year. If you lost that data, you'll have to try and use your memory to figure out what happened. We deal with clients, probably like 50% of our clients every year who say, I can't get something. So, this is an area that we have specialty in. If you need help because you have missing records, we can help you reconstruct that data and come up with a reasonable gain calculation. How should I report a financial NFT that earned revenue rewards if I held it for over a year and then sold it after 1 year? Is that considered a long-term capital gain? Yes, NFTs that are held for over a year are going to fall into that long-term capital gains. The rewards that you earn are going to be reported as income using the fair market value at the time you receive them. How do you correct proceeds if Form 8949 must match what the exchange reports? You'll have. Oh, go ahead.
First of all, the 8949 does not have to match the exchange reports, the 1099 DAs. There's a proceeds column. That's what you get when you sell or exchange it. The totals on the 8949 should be equal to or greater than the amounts reported on the 1099 DAs. And the greater it is, the safer you are.
If I bought Ethereum on multiple platforms, stored it on a ledger, then sold some on Coinbase, how do I determine which coins were sold and their cost basis? So you'll have to get all the information you can from the various platforms. Get the purchase information. If you can't get that, you may have to use a reasonable estimate on the Ethereum cost basis. Maybe every time you purchase on these platforms, you transfer to your ledger, and so maybe that's the approximate price you purchase those Ethereum tokens on, and that would be my approach to that.
All right, our time is up in our AMA. We enjoy answering these questions, and I'm sure everyone's learned a lot of information. And many questions we weren't able to get to, and we didn't have time to do that. I'll work with my staff to put those together so that we answer those questions in not AMAs, but shorts or videos or direct answers on to our X channel, Crypto Tax Fixer, CoinTrack, and CryptoTaxAudit pages. Hopefully you subscribe to those to hear about this. Thank you very much. And remember, if you have a situation, it pretty much pays to contact us to get a quotation, get some insight on how to address your particular unique challenge. And everybody's situation is very valuable, and you have a confidential discussion. Go to our contact webpage. I think the URLs come up during our call. Thank you very much for your time, and I appreciate it very much. Please like and
Thank you,
subscribe.
everyone.
Thank you.